Good day, everyone. Thank you for joining me today. In this session, we'll explore the essential topic of types of budgets and financial plans. Understanding budgets and financial plans is crucial for managing resources effectively in any organization. This knowledge helps us make informed decisions, allocate resources wisely, and achieve our financial goals. Today, we will cover 1. The importance of budgeting and financial planning. 2. Different types of budgets. 3. Key components of financial plans. 4. How to create and implement these budgets and plans. Let's start by discussing why budgeting and financial planning are vital for organizations. Budgeting and financial planning are fundamental aspects of effective financial management. Here are some key reasons why they are important. Resource allocation. Budgets help allocate resources to various departments and projects based on organizational priorities. Performance measurement. Financial plans and budgets provide benchmarks against which organizational performance can be measured. Risk management. By forecasting revenues and expenses, organizations can identify potential financial risks and take proactive measures. Informed decision-making. Budgets provide critical data that supports strategic decision-making and long-term planning. Financial control. Budgeting allows organizations to monitor spending and ensure that they remain within their financial limits. Understanding these benefits sets the stage for our exploration of different types of budgets. There are several types of budgets that organizations can use, each serving a different purpose. Let's discuss the main types. Operating budget. This budget outlines the organization's expected revenues and expenses for its regular operations over a specific period, usually a fiscal year. It helps ensure that the organization can continue to function effectively. The operating budget typically includes revenues, expenses, and the expected profit or loss for the period. It is divided into various categories such as sales revenue, cost of goods sold, COGS, operating expenses, fixed and variable, administrative expenses. Capital budget. A capital budget focuses on long-term investments in assets such as equipment, buildings, and technology. It outlines expected expenditures and potential revenue generated from these investments. The capital budget is essential for planning long-term investments in assets. It ensures that the organization invests wisely and considers the potential return on investment, ROI. For instance, if a manufacturing company wants to invest in new machinery, it will evaluate the costs, expected production increases, and associated revenue before proceeding. Cash flow budget. This budget projects cash inflows and outflows over a specific period. It is crucial for ensuring that the organization maintains sufficient liquidity to meet its obligations. A cash flow budget is vital for maintaining liquidity, ensuring that the organization has enough cash to meet its obligations. Components of cash flow budget. Cash inflows. This includes revenues from sales, investments, and any other sources of cash. Cash outflows include all expenses such as operating costs, loan repayments, and capital expenditures. Net cash flow. Calculate the difference between cash inflows and outflows to determine whether the organization is expected to have a cash surplus or deficit during the period. Zero-based budget. Unlike traditional budgeting methods, which often use previous budgets as a baseline, a zero-based budget requires all expenses to be justified from scratch for each new period. The zero-based budgeting method starts from a zero base, meaning every expense must be justified for each new period. This approach helps organizations identify unnecessary expenditures. Flexible budget. This type of budget adjusts based on changes in activity levels or other variables. It allows organizations to account for fluctuations in income or expenses. A flexible budget adjusts based on actual activity levels, making it a valuable tool for managing variable costs. Now that we have discussed various types of budgets, let's move on to the key components of financial plans. Financial goals. Clearly define short-term and long-term financial goals, such as revenue targets, profit margins, and return on investment. Budgeting. Include budgets, operating, capital, cash flow that align with financial goals. Forecasting. Use historical data and market trends to project future financial performance. Risk management. Identify potential financial risks and outline strategies to mitigate them. Monitoring and reporting. Establish processes for tracking performance against the financial plan and reporting to stakeholders. Example, An organization may set a financial goal of increasing revenue by 10% over the next fiscal year. The financial plan would outline the budgets, forecasts, and strategies to achieve this goal. Let's now discuss the steps involved in creating and implementing budgets and financial plans. Gather data. Collect historical financial data, market research, and stakeholder input. Define objectives. Establish clear financial objectives that align with organizational goals. Develop budgets. Create detailed budgets for various departments and functions. Review and revise. Review the budgets and financial plans with stakeholders, making necessary adjustments. Implementation. Communicate the budgets and plans to relevant parties and ensure everyone understands their roles. Monitoring. Regularly track performance against the budgets and financial plans, making adjustments as needed. In conclusion, understanding the different types of budgets and financial plans is crucial for effective financial management. There are various types of budgets, including operating, capital, cash flow, zero-based, and flexible budgets. Financial plans should include clear goals, budgets, forecasting, risk management, and monitoring processes. Effective budgeting and financial planning are essential for informed decision-making and organizational success. Thank you for your participation today.